Greetings, it is time for our monthly central bank balance sheet report and the attestation of how the atom thesis continues to manifest because exponential money printing serves to merely offset technological deflation, which of course is spreading through the economy exponentially. And therefore we now have the data for February of 2022. So as with other months, we look at the Yardeni balance sheet, which will be in the description box below, and it's updated almost every business day. And they also helpfully provide their contact information over here if you want to contact Dr. Ed Yardeni and express thanks for the work that he does. Feel free to do so. First we go to this chart, figure number 1, which is the cumulative money printing as measured by balance sheet expansion of the 4 major central banks of the world, which collectively comprise maybe 90% of the world's money printing. Not 100%, but these 4 combined are 90%. As you can see, the US Federal Reserve is not even the largest money printer. It's also the only one to ever try to undo its balance sheet, which quickly became very unsuccessful and they had to print more than ever before. But you hear all sorts of ridiculous things in the media about how the Federal Reserve is printing money, therefore there'll be inflation in worldwide commodities. As you can see, the US is not even the largest money printer. It's only about 25% of the grand total. Whether the US prints a lot more or a lot less than it has been doing right now would not affect the world total very much. An increase in the Fed funds rate can affect affairs in the US, but that also quickly gets reversed because the fact that money printing has to rise means the Fed funds rate also has to be zero forever, which we'll talk about in the second section of this video. But as you can see, the US Federal Reserve has done 8.9 trillion since the beginning, and the ECB has done more. It's done 9.8 trillion. Therefore, the only number that matters is the combined total of all 4 of these. And for that, we go to this chart, figure 2. You can see how the combined total is rising on an exponential trend. And I said this in my Atom publication, which I published in early 2016 when I had a lot less data to go off of than we do now. But on my blog, The Futurist, I have articles citing this going all the way back to 2006, so even before there was quantitative easing at all. And at some point we'll do a deep dive into what I wrote even in 2006. So I'm really the first to come up with this, and this will seem self-evident in the future. It's taking longer than it should because the economists of the world have memorized a theory based on a set of observations that occurred in the middle of the 20th century, but they could not see the greater whole because unless you rise to a certain elevation, you don't see the curvature of the Earth. If you're standing on the ground, it won't be obvious that the Earth is a sphere. And the same is true for what PhD economists believe to be true when the first principles of technology and economics say otherwise. So this is rising exponentially. And does this cause inflation at all? Well, whatever small inflation we're seeing now, why is it only showing up now rather than in the prior 12 years of all this exponential money printing? And why is it so uncorrelated with money printing? Well, because it is not because of money printing. The inflation that we are finally temporarily seeing is only because the US has deliberately halted natural gas and oil production domestically, which is a very foolhardy thing to do, but that's causing a one-time upward shift. And we'll talk about that in this video as well. This is going to be a very detailed and lengthy video. So what is the year-over-year growth rate? I contend this has to rise at 16 to 24% a year on a compounded basis just to be at equilibrium with offsetting technological deflation across the worldwide economy. 31.5 trillion has been done to date by those 4 central banks, and guess what? That has to keep on rising. The 2010s decade did 23 trillion of money printing, as you can see, from the beginning up to January 1st, 2020. And the PhD economists of the world not only believed all this would be undone, they believed that would happen in relatively short order. So they said the 2020s would have minus 23 trillion of money printing, as you can see from this table over here. Whereas I have said that this decade, the 2020s, will have 50 to 100 trillion dollars of money printing, as you can see from this table. And from what we can see to date, it's turning out that I am right and they are not. How are they going to undo what is now $31.5 trillion of money printing? They can't. And the remainder of this decade, which is less than 8 years remaining, is going to have another 40 to 90 trillion on top of what has been printed to date, making it 50 to 100 trillion for the total decade. So bear that in mind. So far, I'm turning out to be right, as has always been the case in this connection between technological deflation and money printing. And all these decorated PhD economists are proving to be wrong because they've all just memorized the same thing. There's no real innovation in that field. There's no field where the establishment is more out of touch with their own field of study. Therefore, they just know so much that isn't so. It's kind of funny. So what is the year-over-year growth rate? I say 16 to 24%. You can see now that the year-over-year growth rate is well below that range. It's only 9.1%. So the peak, which could have caused inflation then, which was in February of 2021, was 46%. 46%, and it's been moderating ever since and is now well below the band at just 9.1%, below what it should be. Now remember, just to have 20% growth from now to 12 months from now, so from February of 2022 to February of 2023, 20% growth would be more than 6 trillion more of money printing, and that would only move the line from here to about here. And that's the middle of the band, I say, 16 to 24%. It is rarely even well into the band. It only touches the very bottom because they're so worried that money printing will cause aberrantly high inflation, which has never occurred in these 12 years due to money printing. And the fact that we're seeing a little bit of that now is because of non-monetary reasons. It's because of deliberate supply restriction on oil and natural gas production in the US, which is a terrible thing to do, but a very temporary thing because technology will force them to do that again. So the growth rate year over year hasn't been high for a while. It's only 9.1% over the last 12 months. It is absurd to say money printing causes inflation. If it stayed above 24% for a very long time, then it would be. But as you can see, the problem is not that they're ever going too high. The problem is that they don't make it high enough for the most part. They only briefly did that because of the COVID-19 crisis, and quickly reversed that as soon as they saw that, hey, things were starting to get better. They're not tapping the full potential of monetization of technological deflation, which would be a great thing for humanity, but they're not doing that. And now we go to the next chart. This chart over here becomes more and more important as we continue to hear increasingly shrill and out of touch screeching about how the Federal Reserve is printing money, therefore gold price will rise, and this will happen and that will happen. This is the amount of cumulative money printing relative to the size of the economy of each country or group of countries that a central bank represents. The ECB is for the entire Eurozone. And as you can see, the Federal Reserve is the joint lowest of the four, along with China. The US Federal Reserve has only printed enough money as to be about 33% of its total GDP. And that is what they think is going to cause inflation or even hyperinflation. Europe has done about twice that much. Europe is almost 70% of its GDP. You would think Europeans are the ones most afraid of inflation, but nonetheless, they have printed twice as much money as the United States, and there's no aberrantly high inflation in Europe. But the biggest indicator of all is Japan. Japan has printed a huge amount, 135% of its GDP. Now remember, this is cumulative money printing over a multi-year period, whereas GDP per year is an annual metric, but at least that annual metric is applied equally to all four entities, so it's apples to apples comparison. Japan has done 4 times as much money printing as the United States. Japan doesn't have high inflation, and the people who say the Federal Reserve's money printing is causing inflation, they are effectively admitting they think there's only one country in the world. The United States does 25% of the world's money printing, as I explained. It has done much less than Europe and certainly Japan. And these people refuse to explain how Japan can print 4 times as much money as the US, yet Japan has no aberrant inflation, even now. That is because money printing is borderless and only the grand total matters because technological deflation is borderless. You have to take global metrics in both cases. Both the numerator and the denominator have to be worldwide. So all this Federal Reserve money printing is going to cause gold to go up, even though gold is priced worldwide and the Federal Reserve is the central bank of just one country that does relatively little printing. It is so uninformed that it's crazy. All kinds of supposedly intelligent people are featured on TV and they haven't the slightest clue what they're talking about because none of them can explain how Japan can do 4 times as much money printing as the US and have no aberrant inflation in Japan. And why did Japan's money printing not cause all gold prices in the world to go up? It's truly insane. You have people who cannot think critically that are driving the media narrative. It's really crazy. Now, from this point, we go to the next important metric, which is the Wu-Xia shadow rate. Now, next we go to this Wu-Xia shadow rate, which will also be in the description box below. And while this is a US-only metric, it is the best we've got because we don't have any worldwide metric that combines both the front-end interest rate, which in the US is the Fed funds rate, with the amount of money printing being done. And such a metric would be invaluable because worldwide, as we know, there are $17 trillion of bonds that have a negative interest rate, and that's even before the QE associated with them, as I describe in this video up here. But at least someone makes a US-only metric, so we'll look at that. And as you can see, the structural downtrend is very evident. That means that the Fed funds rate has to be 0 and quantitative easing has to be permanent just from this trend here. And that's why the Federal Reserve is getting more and more decoupled, because they are brute force trying to raise the Fed funds rate, which in this case is also the Wu-Xia shadow rate, up to 3%. They think this is normal, even though this trend is going that way. Therefore, the mega trends of technological and economic forces are diverging more and more from the outdated dogma of the Federal Reserve and Western PhD economists. Because every time they have tried to raise interest rates and stop quantitative easing, there was a big market correction, and they're always forced to do more. It's getting more and more negative. And from 2015, they stopped quantitative easing, raised interest rates. There was a huge correction in late 2018, and then another one due to COVID. And that's why I said March 15th, 2020 was the Netscape moment in economics, because it seemed that the Federal Reserve would be forced to see the light. But no, now they're tightening again. Even though the inflation is not because of anything the Federal Reserve did, it's because of the Biden administration and the U.S. Congress deciding to obstruct domestic oil and natural gas production in the U.S., which caused the price of oil to rise, which is causing CPI inflation, as we'll talk about in part 2 of this video. This is wrongly being attributed to Federal Reserve money printing. Therefore, they are undoing money printing and undoing it fast. Because remember, in the past, the tightenings were more gradual. This is straight up. They went from minus 2% Wu-Xia shadow rate up to 0, and this was before the first quarter point Fed funds rate increase that just happened last week. So it's already 0.25, and they're going to raise it a little bit, and then there'll be a market crash, and they'll be forced to do more. They actually think that being up here at plus 3 is normal, when it's obvious that minus 2 and dropping is what is normal. More negative is good, remember, because that means more money printing that circulates in the economy and more exponential economic growth measured through stock market increases and just circulation of M1 and M2 money, which is fast velocity money. So this ideological dogma is really, really problematic, because the evidence against what all these PhD economists believe is piling up, yet they continue to raise the Fed funds rate. And when something like an oil spike like this occurs, it obscures the truth in that they think, hey, there's high inflation now, therefore the Federal Reserve has to stop printing. Again, even though the US Federal Reserve is only 25% of world printing. It is quite problematic, and a large stock market correction is all but certain when they're tightening this much. The only way around it is if the other central banks of the world print even more, so that the US tightening is a very minimal amount relative to net world money printing. But so far that isn't happening, because that year-over-year growth rate worldwide is also moderating. So beware. That's why I have some videos that say these are the indicators to look at as precursors to a stock market crash. And we're going to keep having videos about that, because that is what all indicators are pointing towards, because of this very overt and unnecessary action from the Federal Reserve. They think they're going to be up here plus 3%, whereas I'm certain that in a couple years' time they'll be at minus 2% again, simply to keep that worldwide total quantitative easing chart that we saw earlier on the natural exponential trend. Now remember, all these PhD economists have memorized certain data points from the mid-20th century, and they think that is what is normal. And it's very much the analogy of they are trying to ascertain by standing on the ground whether the earth is a sphere or whether it's flat, whereas you have to rise to a certain height to ascertain that, yes, it is a sphere. Remember that a young PhD economist has to repeat this dogma even if he secretly knows it's wrong, because that is what the entire profession and all the high prestige organizations in his field require him to say. His supervisors want him to parrot back this accepted wisdom, quote unquote, even though it is empirically false, and that is how he gets promoted. If he starts to say, hey, the Fed funds rate should be 0 forever, and monetary creation, money printing, does not cause inflation because technological deflation offsets it, he won't get promoted. His career will suffer. That is how these ossified institutions propagate ignorance, and then there are big tectonic shifts in the world. When you have an entire profession that is out of touch with the pure fundamentals of its own field, as is the case with the PhD economists versus what is actually happening in economics, then major historical turning points are imminent. And certainly in something as important as macroeconomics and central bank policy, as opposed to something esoteric. The Federal Reserve is going to cause all kinds of turmoil and hardship that is absolutely not necessary, because they refuse to see how the trend here is downward facing, negative, yet they're trying to artificially force things back up to plus 3, and all market forces are going to fight with them, and the market forces eventually win, although the damage is not withstood by the PhD economists at the Federal Reserve. It is withstood by hundreds of millions and even billions of ordinary people. And you have even more confusion when you have a brief upward blip in inflation That is not because of monetary creation, because monetary creation has been going on for 12 years already, and the current amount is below average, in fact, as measured by the year-over-year growth rate, but because of something else, which was more of a government decision in the executive and legislative branches rather than the central bank, which is to reduce oil and natural gas production. So how much inflation is there really? For that, we continue to part 2 of this video. As anyone who is watching the news can see, the media is in complete hysteria about inflation while not being willing to attribute whatever inflation upticks we're seeing to the true cause, which is a deliberate reduction in domestic oil and natural gas production, and not Federal Reserve quantitative easing, which has been ramping down for quite some time and also was going on for 11 years, as I often describe in my other videos around quantitative easing. But for today, we're going to talk about just inflation. And long-time viewers know that I set a very straightforward metric of when inflation is at an optimal point and above which it will be considered high. And I'm going to add a third parameter to that. And that third parameter is the 10-year US Treasury yield, whether that is 3% or not. Now, why am I adding this parameter? Because this is a reflection of future expectations of inflation, where the CPI is the past and the Goldman Sachs Commodity Index is also the past. And I'm keeping this at 3% simply to be uniform with these other two metrics. However, 3% is a very, very, very low bar. The Fed funds rate can be 0% and the 10-year yield can be 3%, and that's still a 3% yield curve spread. So this is a very low bar. It would be actually more appropriate for me to make this 4%, but I like the symmetry of 3, 3, and 3. And therefore, I consider inflation to be problematic only when all three of these numbers are above 3%. Again, this is not making the criteria more stringent because this is a very, very low bar. For most of the last 70 years, the 10-year US Treasury yield has been a lot higher than 3%. But in this atom age of technological deflation, I believe that is permanently no longer going to be the case outside of very brief episodes, if that. So what have each of these numbers gotten to in the most recent month? That is the subject of this video. So for that, we go to the first one, the US CPI. So as always, we go to the BLS website and we go to Consumer Price Index over here. And then we go to formatting options to see more choices. So we'll choose original data value and 12-month percentage change. So this is the original value of the CPI. And remember, this steep upward curve is only offsetting the negative portion from here. And you have to look at this in a geometric sense. So what is the 10-year average CPI? That doesn't move that easily because we want to smooth out short-term spikes and troughs. Right now, the media is trying to make everyone hysterical about inflation, but when inflation was in reverse, in deflation, during the start of COVID-19, and also during 2014 or so, then these inflation mongers were nowhere to be found, when in fact, deflation is more worrisome for the average person than inflation, as I explain in this video up here in the upper right-hand corner. So we take this scientific calculator and take the 10-year average inflation rate by taking months that were exactly 10 years apart at the beginning and end of the 10-month series. So we take this number 284 and divide it by this number 229. So 284 divided by 229, 1.24. So 24% inflation over 10 years. How much is that per year? We take the 1/10 root of this number to determine how much is the average inflation per year over this 10-year period. I hope everyone understands the arithmetic of how that is done. X raised to y, 0.1 is the 1/10 root. You get this number, and then you minus 1 and multiply by 100 to get the percentage. 2.2%. That is the average CPI inflation rate over the last 10 years. It's a little higher than the prior month and the month before that, but it's only edging up by about 0.1% per month and is nowhere near the 3% threshold that I set in my inflation criteria table that you just saw. So 2.2% is the average CPI inflation rate in the United States over the last 10 years. Now, the United States is only one country, and saying that Federal Reserve printing is causing inflation is not only wrong from an atom point of view regarding technological deflation, it's also wrong because that is a US-only metric, not a worldwide metric. Both Europe and Japan are doing much more quantitative easing than the United States did in proportion to the size of their economies, and nobody claims those places have high inflation. Inflation is only high right now because the United States deliberately clamped down on oil and natural gas production domestically, which nobody who wants the well-being of the U.S. economy would ever possibly do, because that was the best thing to happen to the U.S. economy in the last 10 years. As we go down to these annualized inflation rates, yes, it's very high right now, but this gradient is already saturating substantially, and that's why the average was the 2.2% that we saw. I've said for several months that by April, May 2022, which is next month after, this is going to start coming down on a year-over-year basis. The recent oil spike might have delayed that a little bit, but any oil spike attracts more technological forces to bring it down into deflation, and also the geopolitical events that happened because of the rise in oil price that might not have happened otherwise. So we'll see, but this 10-year average is the one that matters. And now to get a worldwide metric, and since we're talking about oil, we go to the second parameter in my table, which is the Goldman Sachs Commodity Index. This is the Goldman Sachs Commodity Index. And the 10-year inflation rate of this is 0.47%. Now, for a long time, it was in negative. Recently, things have spiked up, mainly because of oil. And the oil spike, once again, is because the current administration has clamped down on domestic oil production and natural gas production in the U.S. This has caused the worldwide price of oil to rise, and a lot of oil-producing dictatorships become emboldened when that happens, and then they do things that make the price of oil rise higher still. But then this gets reversed very quickly, and we will see this fall just as swiftly as it rose, mark my words. But the 10-year compound annual growth rate of this is nowhere near 3%. I actually want this to get up to 3% so that there is more technological disruption of commodity prices and the supply of oil, natural gas, gold, copper, and everything else increases a lot, causing another decade of deflation. The atom, the accelerating tectonic medium of the world, is attracted to things that are unusually expensive, and when commodity prices rise due to some aberration that attracts a greater percentage of the atom leaves the other disruptions it was working on and gets to work on crushing this particular price increase. And we've seen this happen time and time again, and I have many videos on this channel about that. So commodity prices, which is the purest metric of inflation because it's worldwide, it is not distortable by just U.S. central bank money printing, contrary to what all these inflation mongers on television say. Remember, the United States has only done 25% of the entire world's money printing. So to attribute U.S. money printing to worldwide commodity price increases is absurd. And oil prices only rose because of the reasons I mentioned, a deliberate reduction in U.S. oil and natural gas production. Quantitative easing has been going on for 12 years, greater than the duration of this entire chart, and there was deflation along the whole while. So then this takes us to the third parameter that I track, which is a new parameter that we are discussing for the first time in this monthly series, and that is the 10-year U.S. Treasury yield. The Treasury yield is only 2%, 2.00 exactly, in fact. It's nowhere near 3%, and it was above 3% and even well into double digits during the 1970s and early 80s for a while. And even during the 90s and 2000s, it was well above 3%. But now I believe it is permanently below 3%, barring certain aberrant things that the Federal Reserve does, such as temporarily try and unwind its balance sheet by selling treasuries back, which always gets reversed because the stock market corrects and forces them to buy treasuries again. So it is only at 2.00%. At its lowest point, it was under 1%. It has now risen to 2% because quantitative easing has ended. But each rise becomes exponentially harder because then the economy contracts and the Federal Reserve has to print money again. So this is the 50-plus year chart, and to show how 3% is now hard to reach, even though it was above 3% all the time until recently, is just a tremendous validation of the atom thesis and how technological deflation is pervading into more and more things. Bonds as an asset class are becoming unviable under the reality of exponential technological deflation. I wish the governments of the world were able to see that. And remember, the U.S. Treasury rate is still plus 2%. There are, in fact, $17 trillion of sovereign bonds worldwide that have a negative interest rate, so below zero. Negative interest rate. I described that in this video up here. If you want to see a shorter term, I go to the 5-year chart. You see, it could only get above 3% for a short while in the summer of 2019 because the Federal Reserve was tightening rapidly. And that type of artificial tightening got immediately undone because of the COVID-19 crisis, but they would have had to print more anyway because the stock market would have corrected. And now it's languishing at 2%. You simply cannot go back to the assumption that we're going to have high inflation and yields are going to return to 7%, which is what all those PhD economists have memorized as being normal, simply because that's what the yield was when many of them were in school studying for their PhDs. Just because that was when they were around, that's what everything has to be, and therefore their policy thought is so tainted and so intellectually empty that it's really quite a shame. But this 10-year Treasury yield is an important metric. Even though it's a US only metric, I could be more stringent and require all sovereign bonds of all the major economies to be above 3%, but that's even harder to get. I just want the US Treasury yield to be above 3% before we say that inflation is starting to get high. And that has to happen in conjunction with the other two metrics, the CPI and the Goldman Sachs Commodity Index, 10-year compounded annual growth rates also being above 3%. So now we go back over there. So here we are. US CPI should be above 3%, and Goldman Sachs Commodity Index should be above 3%, 10-year compound annual growth rate in both cases, and the 10-year forward metric, the US Treasury yield, should also be above 3%. And unless all three of these thresholds are breached at the same time, I don't care if one is above 3% and the other two are not, all three have to be above 3% at the same time. That is still a very, very low bar, because for most of the time before the age of quantitative easing and technological deflation getting into critical mass, all three were above 3%. If you go back to the 1970s, all three were in double digits even for a certain period of time. So what does this month register at based on what we have just seen? CPI is 2.2%, as we saw in this video. The Goldman Sachs Commodity Index is at 0.47%, still a long ways from 3%, but this is pretty volatile. This can go above 3% and below 3% in a short time. The other two can't move that quickly. And the US Treasury yield is at 2%. So still a full percentage point before it gets to 3%. Inflation is nowhere near any structural worrisome threshold at all. Don't watch the daily news because it will make you crazy and lead you into bad investment decisions. This current inflation spike will vanish just as quickly as it arose, even though there are multiple artificial factors working towards worsening inflation, such as a deliberate reduction in US natural gas and oil production, without which not only would we not have even had the small blip that we're seeing now, but you also would not have had Russia invading Ukraine at all, because they would not have the confidence to do that, because Russia is an oil-centric economy and is heavily dependent on selling its oil to other countries and earning revenue from that. But none of these metrics are near 3% at all, and that is the takeaway from this video. Stay the course. We are entering the atom age, the age of exponential technological deflation, and absolutely nothing that's going on is contradicting the thesis at all. And I've been consistent about this throughout, 3%, 3%, and now I'm adding this 10-year Treasury yield simply because I'm confident enough that this very low bar, much lower than it was for most of the entire half century before the last few years, is also something that will not be breached very often anymore, because like I said, $17 trillion of bonds outside the US have negative yield. The US at least still has positive yield. I hope you found this video to be educational and informative. If you like this type of content, I encourage you to upvote this video, hit the notification button, and subscribe to this channel. Thank you very much for watching.